So let's talk a little bit about the word in what you're saying. The deferred trust is the deferred part. So deferred means we're kicking the can down the line. Okay. So at what point in time, or how does that work? Where do the taxes become real for a person, and what should they do to plan for that? And just how does that whole thing work? Because I love the word deferred. It's not as good as tax-free, but deferred is great because it means I don't have to pay today. But the biggest problem I see with that is taxes, as you and I know, they either go up or they go down. And guess what? They don't ever really go down, but they might not go up. But if they don't go up, they just find more crap to tax us on. It's the reason if you go to Florida, maybe even California, there's a toll booth every half a mile. They don't have state income tax, so they got toll booths. You see what I mean? They just find more stuff to tax us on. So if we know taxes are going up and we're just deferring the tax liability here, like how does that look? Like how do we mitigate that? How do we plan for that? What would be the next step?
Great question. So first of all, the premise is pay the tax, you lose or defer the tax and you win as long as the tax liability is big enough. Second premise, most of our clients like to pay the tax the second day to never. So Chris, when would you like to pay the tax? Well, you might say, well, never, Brett. I'd like to just live off the interest for as long as I want. So back to Peter's deal. Peter paid off his debt about $500,000. He deferred $500,000 in gain, and so now he's about $1.3 million versus $800,000. So he's a baby boomer, and he's going, okay, an extra $500,000 in wealth. He says, Brett, when do I have to pay the tax on that? And I said, well, Peter, when do you pay tax on it now? He goes, well, when I receive the money. Exactly. So as long as you don't receive the money, you don't pay tax. Well, what about the interest payments? Well, yeah, of course, you'll pay ordinary income on those interest payments. And most of our notes are structured as 10-year notes, earning somewhere around 8%, depending on the portfolio and the risk tolerance of the client. But that's how Peter's was structured. It's about an 8% payout was what we're targeting. And he's gonna live off about 6%. He's gonna keep a little gap there because some of it's going to be in fees and a little bit's going to stay in principal. So as long as he does dip into the principal of $1.3 million, he's in a tax deferral state because he hasn't received what's called actual receipt. Now the interest payments of about 6%, he's going to pay ordinary income tax on that. But the cool thing is it's on the $1.3 million he's making that 6% rather than on the $800,000. So he's happy because that's an extra 6% on the $500,000. So he goes, well, Brett, what happens then when I pass away? Well, this moves to my wife. Yes. And then what happens if we both pass away? Can it move to our kids? Yes. And as long as they keep that principal in place and just live off the interest payments, they're only paying ordinary income tax, and those principal amount is in a deferral state. Now, a different client, they decided, he just sold another multifamily property here in Sacramento. He's actually younger. He's in his late 40s, and he actually still has income coming in, a W-2 job, and he has multiple multifamily properties on the side. And he actually didn't need or want the income coming in because his tax bracket was already so high. So actually, the cash flow that was producing off his real estate asset was adding to his overall net taxable income. But here's the cool part. Now that we go into the trust, he can decide to have that interest that it's earning compound on top of the trust. Therefore, what happens? His taxable net income goes down. And at a later date, when he, let's say, retires from his day job or quits his day job, he can start pulling from this. And since this is a business trust, now we're getting a little bit into the weeds here, but since this is a business trust, it's unique in that it can expense what it earns. Therefore, it's not paying tax on itself. And from the note holder or the taxpayer's perspective, if they haven't received it, they don't own the tax yet until they receive it in a given year. So again, our notes go for 10 years. You can keep renewing them every 10 years and basically just kick the can down the road, which leads into the next question. Why would the IRS allow this? It seems too good to be true. It seems like there's something illegal here. And the answer is it's actually not. It's a study of macroeconomics. And the IRS actually wants to spur economic growth. They want to spur Peter from selling that property. They want to spur the new property taxes that come in. They want to spur the real estate broker who gets the commission and then title. All of those things actually spur taxes to come in. And also, when Peter takes that $1.3 million and he invests it in stocks, bonds, and mutual funds, guess what? That spurs economic growth too, which spurs more jobs, which spurs actually more tax revenue. So it's actually a good thing for the IRS to get more tax revenue in the long run. Although there is this sense that, well, why why can I do all of these things? Why would the IRS allow it? And it's just that. It's a study of macroeconomics, which leads me to the next point here before maybe you ask another question. How long has this been around? It's been around since the 1920s. This is IRC 453. It's known as an installment sale, which you and your listeners probably know, where you can carry back paper. The difference is we're adding a business trust to do a deferred sales trust or a specialized installment sale. And when you add the two together, you get the foundation of long tried and true tax law with our proprietary way in which we apply it. Then you couple that with the thousands of closes we've had, which is really important for your listeners to understand. You want to make sure whatever tax deferral strategy you decide to choose, it has a long-standing track record. And not only have they've closed, let's say hundreds or thousands of closes over, let's say 24 years, which is ours, but has the IRS looked at it? And has the people who used the structure been audited? And what was the outcome of those audits? And for us, it's 14 no-change IRS audits. The largest one was $125 million in San Diego. All that being said, you want to make sure that you're safe and you can sleep at night in whatever structure you're going to use.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.